Money FM 89.3. Best of breakfast. The Bigger Picture, only on Money FM 89.3.
Welcome to The Bigger Picture. I'm Danko. Now, we've got a big week ahead of the data front. Now, over in China, August trade numbers and inflation data are set for release. And this comes as the US and China extend their tariff truce, though questions remain about how long that pause can really last. We'll also shift over to the US markets, where investors will be closely watching as we head into the next Fed meeting on the 16th and 17th of September. So what could this mean for the bond market, equities, and of course, the US dollar? To make sense of all of this, we are happy to welcome on the show Barnabas, the Group Chief Economist and Head Market Research at RHB Bank. Good morning, Barnabas. How are you doing today?
Good morning, everybody. Good morning, Dan.
All right, fantastic. Great to have you on with us. Now, we first turn our attention over to China, where the nation is set to release their August trade data in light of the extension of the US-China trade war truce. And on top of that, August inflation data for the world's second largest economy will also be released later this week on Wednesday, with many projecting price pressures dipping back into negative territory. So amid the erratic trade policy of President Trump, which is putting China's export-oriented economy under intense pressure, how should we be reading the release of China's latest economic data, and what key metrics are you looking out for?
Yeah, so I think you brought in a lot of variables here surrounding trade tensions, surrounding what Trump may do, surrounding what China may do. I think, if we look at where things are right now, things are looking great. Yeah, US and China trade tensions have seen a truce. The new deadline is in November.
Yep.
Markets still appears to be quite optimistic on that front. Markets are desensitized to US and India trade tensions. So things are doing well. But the problem is this. We still have some sense of uncertainty surrounding what tariffs may pan out into the second half. And if we look at where China is at the moment, trade has been slowing. And if we look at August print, which is upcoming, market expectations are actually expecting that the export growth might likely slow further in August. That could actually be from a base effect. But I think from where we are looking at right now, I think there may be some waning of export momentum that may be expected into China. And probably now that we are in ASEAN, in Singapore, what does that mean for ASEAN? I think because we are very reliant on China's health, and that may mean that a slowdown in Chinese growth and Chinese exports might mean further deterioration on the external front of ASEAN. So probably there's something to watch for.
All right, thanks for the breakdown, Barnabas. Now, the economists have also warned that Trump's tariff stopping 35% would become prohibitively high for Chinese exporters, especially since how they appear to be struggling to chart a path beyond the current pause. So beyond shifting their export focus to more markets in Asia, Africa, and Latin America, how do you see officials in China spurring domestic demand and offset weakening exports then?
I think right now we are already seeing that China, for the course of this year and of last year, the Chinese government has actually engaged in interest rate cuts, from its RRR to its LPR. And that essentially means that monetary policy is one of the key tools that the government is trying to engage in, trying to shore up growth and shore up consumption. The RRR cut is likely to also support the liquidity, in the economy. And that could also mean that, banks, financial markets will also stay supported on the Chinese front. What else they could do? I think further rate cuts might be expected, and that could further shore up growth. But I think the concern that we have as economists is that a lot of the growth right now, some of it might be driven by debt. Yeah, that accumulation because of very, very accommodative rates that has been seen in the Chinese front. And that basically has actually translated into very high debt levels from a national point of view, from a household point of view. And I think this is something that markets should also be watching for into the medium-term perspective.
All right, food for thought there. Thanks a lot, Barnabas. Now let's shift gears over to the US, where we're stepping closer to the next FOMC meeting on September 16th and 17th. And key points of interest would likely be the US Consumer Price Index print on Wednesday and Consumer Price Index report on Thursday. They're likely to review impacts from the import tariffs. We're seeing how last month's PPI data showed US producer prices increased by the most in 3 years in July, and that's as the costs of goods and services surged. So what will you be keeping an eye out on as we await the release of the impending trade data?
So probably three things that I should watch out for, and I know that I have an interest of time on the radio, but maybe the first thing really is that if we look at what the Fed may do based on the economic data, the labor front is weakening. The second point really is that inflation is spiking, especially from the producer price index fund, as you mentioned. Last but not least is what could that impact ASEAN. So let me just break it down. First and foremost, I think that US may prioritize is the weakening labor rather than the inflation pressures within the US front. Yes, inflation is picking up and PPI is very high, and if it still stays at 0.3 or higher, that basically means that from the core PCE inflation perspective, which is the preferred inflation proxy by the US front, may mean that inflation pressure still remains quite elevated. But I think what the Fed may be positioning is that inflation may be transitory, given that it's tariff induced, and that means that the labor front might be something of priority right now rather than the inflation front. But I think overall, if you wrap up everything together, and we sitting in ASEAN, should we be worried about the higher inflation trend in the US? Probably not, because our trading ties still remains very strong with China rather than the US. And that essentially means that because we export more to the US, maybe except for Singapore, but from ASEAN, most of the ASEAN economies have actually trade surpluses with the US, so we export more to the US rather than we import. And that essentially means, that maybe the inflation pressures within ASEAN would be induced by China rather than the US.
Fantastic. That's comforting to hear at least. And this brings us well and nicely over to our next point, which would be the rate cut, which many are expecting more accelerated easing after a weak jobs report, like what you rightly mentioned. Unemployment rate increased to a nearly 4-year high of 4.3%. So is a rate cut on the table? If so, how much are we expecting, especially in light of a possible rise in inflation in this tariff-induced economic environment?
Yeah, I think what the markets fully agreed on, including myself, is that at least a 25 basis point cut, 0.25%, it's on the table on the 16th to 17th of September this month. And that is a reflection of, as you have mentioned correctly, then, the weakening labor front. But the thing is that, because of the elevated inflation that might be coming in, then probably another one more rate cut might be on the card into the end of the year, and that basically brings the cumulative rate cuts to 50 basis points, 25 in September and 25 in December, and that will bring it to 50. And I think that's it, at least for this year. I think the Fed it's a very hard call, at least from a policymaker's point of view, and the job is very challenging, from that front. I think simply because they have to balance inflation and the weakening labor front. And I think that they should not be pulling the trigger too hard or too fast at the moment, especially if there is uncertainty over how inflation might react into 2026.
Yeah, I mean, it certainly is a very hard beam to balance as of now, and it's tough to be in the position of the Feds, especially since they need to balance a lot of these data. So let's talk a little bit more about the bond markets, where we're seeing shorter dated end of the US Treasury market performing well in response, while the longer maturities continue to be plagued by concerns around the fiscal spending levels. So what can you tell us about the state of the bond market today, and how are expectations of a rate cut moving bond yields?
Yeah, so I think it's very simple. It's a very simple correlation behavior that we are seeing right now. Bond yields are falling, both on the 2-year front and on the 10-year front, from the U.S. Treasury's point of view. Yeah, and that is a reflection, most likely than not, falling, more so increased expectations for rate cuts that may happen from the U.S. FOMC point of view, and that. Probably a positive correlation as per your question, how would bond yields move? And that would be a downward move. But if we are, if we wear the lens or wear the hat of a trader, what should we do? With falling yields, prices go up. Yeah, and that essentially means that before yields fall even further, probably there may be a need or advocate higher exposure to especially long-term, long positions in short-end rate instruments, such as 2-year Treasury futures or the SOFR futures, and of course, even the long end as well, especially when there is going to be further rate cuts, so probably extend duration into the longer term of the Treasury, exposure. That basically will seal yourself into, say, an overweight exposure on Treasuries and on fixed income. This is especially on the fact that things might not go well into the second half. As I mentioned, there'll be uncertainties over the tariff front.
Yeah.
And of course, with growth likely to, pen lower given the external front from China and ASEAN. And that basically means, exposure to defensive play might be advised at the moment, yeah.
All right, that's a wonderful breakdown of all that we need to understand about what's to be expected and how we should be reading latest economic data to be released this week. Thanks a lot for joining us this morning, Barnabas.
Thank you, Dan. Take care, everybody.
You too. Now, we've been speaking to Barnabas Gan, the Group Chief Economist and Head at Market Research RHB Bank. Keep it right here with us on Money FM 89.3.
To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.